Standard Chartered and CNBC-TV18 present India on the Move, Season 6.
Hello and a very warm welcome to Season 6 of Standard Chartered and CNBC-TV18 present India on the Move, a conversation series where we engage with thought leaders and business experts in understanding new developments in the global and local economies, trending industries and markets in India. I'm Mugdha Kalra. A turbulent 2023, characterized by major global upheavals like the Russia-Ukraine conflict, aggressive interest rate hikes from major central banks, banking instability in the US and the Israel-Palestine war. But India has successfully maintained its stability. Despite these challenges, the Indian rupee has demonstrated stability in recent months. Both equity and debt markets have avoided significant downturns, and bank credit has sustained at decade-high levels. Will India continue to navigate through these demanding global circumstances? Let's find out from our panel today. Joining me in the studio, Parul Mithil Sinha, Financial Markets Head India and Co-Head ASEAN and South Asia, Macro Trading, Standard Chartered Bank. Lakshmi Iyer, CEO Investment and Strategy, Kotak Alternate Asset Managers Limited. And Utsav Bejal, Partner, Head of India Private Equity, Apollo Global Management. I welcome you all to the studio, and I'll go gentlemen first. So Utsav, given the interest rates are elevated across the globe, and specifically in the US, there is also liquidity pressure, and it is likely to accelerate in 2024. What does it mean for the global markets, and also specifically when we talk about India?
I think we've lived through a very interesting year. I think all of us on the panel would agree that we're probably better off than we expected. But I think cracks are finally getting visible. We are seeing the end of the excess savings which the US consumer had built up. We are starting to see delinquencies go up in the US. China slowing down is obviously not going to be helpful for the global economy. So we are starting to see some headwinds which we were probably expecting this year. I was reading a report and it said that the percentage chance of a recession in the US is now up to 50%. It's almost as high as 70% in Europe. So I expect the global economy to be slower. Now, luckily for us, I think India is in a pretty good position. We had not spent through the COVID crisis, so I think that's helping us. And rates are still stable. And I think the Indian corporate is much healthier today than even 4 or 5 years ago. So I'm pretty optimistic that India will survive through this despite a pretty difficult 2024.
Parul, if I may get you in, do you take the sentiment forward with Utsav? Do you believe that we are in a better place vis-a-vis what we were expecting to be at when the year started and when we were seeing a lot of volatility? And what really is your sense of what is happening around with RBI and the central banks across the globe?
Absolutely. I think India has emerged as a shining beacon of stability and growth for the entire globe. Where are we today in terms of growth? Much better than where any economist had projected to be in the beginning of the year. This was acknowledged by the RBI also in the last MPC, where the growth forecast for this fiscal year has been moved higher to a 7% number. At this rate, we are the fastest growing economy in the world. And we are on track to achieve the Prime Minister's goal to reach the $5 trillion GDP mark in 2027. So on the growth front, we are doing much better. If I look at the inflation, how we are faring there versus how it has been for global economies, we are doing pretty well there, even on that front. So if I look at core inflation, we are, the last print was at 4.25, which is much better than anyone would have expected to be. We are seeing higher prints on headline inflation, more to do with the food inflation, short-term spikes related to local cycles and global cycles. So we are very happy with what RBI and our country has achieved on the macroeconomic front. Looking at other countries, how growth is panning out in, say, China, or the forecast for the global economies, I think India is in fantastically well. In terms of central bank commentaries, we have hopefully reached the peak of tightening cycle. That is what traders, markets are speculating. We are starting to price in cuts, very excitedly. But this has been a very volatile year where markets have had to move from pricing in aggressive rate cuts to then normalizing to Fed or the central banker's hawkish speech. So I think the volatility continues over the next 6 months, but there's a growing sense of confidence that rates have peaked out globally. If we look at the US, Europe, India, most other countries.
Parul, I just wanted to take your attention to RBI's efforts on managing rupee volatility, and what's your broader view on USD, having spoken about what you just did?
So RBI, they've done a fantastic job of managing rupee, volatility around it. Their stated objective has always been to maintain or contain the volatility in the currency, but if it's especially commendable in the context of how other emerging market currencies have fared. So rupee volatility is at the lower end of the spectrum of all EM currencies, leave apart HKD, which is obviously a pegged currency. So there's a lot to congratulate RBI for, and they've leaned against the wind. So even during the COVID years, when we saw a lot of inflows, we saw a balance of payment surplus of around $80 billion. They stepped in to mop up that entire dollar inflows and build up the reserves for a rainy day. They have consistently maintained reserves around above $600 billion mark, more than 10 months of import cover. They have been extremely prudent in the management, which has been acknowledged globally, and that's really helped in maintaining rupee at these stable levels, even as dollar has been volatile. On the broader dollar index, given where we think the rates are globally, that the US rates have peaked, they're likely to move lower from here, we think that we've seen the peak in dollar index as well, at 114 levels last year. It's already come down to 104 levels. Our economists project that it will move down towards 100 levels and then consolidate around there. So another 4% move weaker for the dollar, but then consolidate around there.
Let me bring Lakshmi in here. Lakshmi, financialization of household savings in India has been on an uptrend. Everybody is investing. SIPs are being spoken about. $2 billion is the monthly inflow in SIPs, who would have thought? But how do you see this, and how does it play out in the larger context? And do you see, do you have any kind of a projection for 2024?
No, so before I go into the projections, I don't know how good these projections work, but I think 2023, if you look at it, from a Chinese calendar year perspective, and at least we should bring in China at least for invoking these animal spirits across globe. So it was the year of the rabbit, and rabbit actually, signifies longevity, prosperity, peace. Peace in India definitely was there. Peace, obviously, from a geopolitical perspective, was not there. So I think the prosperity is actually showing across asset classes, whether it's equities. You look at the last 12 months, 24 months, 36 months. You just have to look at the Nifty, for example. It's given, I would say in high single digits or early teens kind of returns, 12 to 13%. But if you look at the mid-market and small caps, they've been absolutely ballistic. And look at gold. Again, that's given returns very much in line with equities in the year to date. I mean, there's 2023 that we're talking about. So I think even fixed income has not been so bad. Of course, it's the poorer cousin of equities when it comes to wealth creation. But nevertheless, it's given reasonably good returns. So if you tie that all in, it's clearly showing you that there is some sort of a TINA factor, or there is no alternative factor as far as India allocations are concerned, whether it is global investors or whether it's domestic investors, where we talk about the financialization of savings. The MF industry has actually crossed the 50 lakh crore mark as far as the AUMs are concerned, and the active SIP accounts are close to about 75 million, or 7.4 crore thereabouts. All that ties into the fact that there is clear-cut, I would say, mandate within the retail households or the HNI households that this wealth creation journey is something they need or they have to participate. You have to wean away from the traditional mode of investments, which barely manages to meet or beat inflation. If you look at the mutual fund flows into equities, net flows, they're kind of receding, which means that at every level the market moves, there is some profit taking. But what's keeping the flow flows buoyant is actually this retail SIP flows. So I think annuity clearly is defining the momentum. And yeah, the overarching narrative obviously is that with reasonable stability, which both Utsav and Parul spoke about, India is. Have you seen the movie Sam Bahadur, the Bollywood movie? So in that, Sam Manekshaw's tagline is "I'm okay." So India is clearly India Bahadur, which is saying "I'm okay."
Utsav, talking about capital inflows, which are the sectors that are really attracting investors' attention, and is it because of structural changes that government has introduced, or is it cyclical in nature? A lot of people are interested in what's happening in the IT sector. What's your take on it?
I think the themes are pretty consistent over the last, I would say, 5-7 years. One is, what is the government doing with respect to manufacturing? So I think a lot of the initial work on PLI schemes, the China Plus One theme, is seeing, finally private equity interest build in manufacturing. So we are seeing a lot more. You spoke about financialization. I think that has definitely been a theme where I was looking at some data, almost 60% of all NBFCs above a certain size are owned by private equity today. So that's a space where they've tried to push the financialization of savings a lot more. So that's the second theme. And the third is where India is competitive, right, which is services and pharma. I think those two sectors have probably got 50% of all flows, and that continues to be the same this year as well. I think the only one thing which everyone's sort of thinking about now, in addition to these sectors, is what do we do with respect to infra and ESG. But those are the two new sectors which have again come to the forefront. But other than that, we've seen private, about 70% of all money made by private equity over the last 10 years are in the three sectors I spoke about. So that theme continues.
Parul, adding to the capital flow and inflow question that I asked Utsav, but we're talking about now JP Morgan's recent announcement of adding Indian government bonds to its emerging market index from 2024. It looks quite happening and significant. What do you think the impact is likely going to be?
So addition of IGBs to the JP Morgan EM bond index, it is a huge deal for us, for the markets, right? So we've been talking about this possibility for many years. But one, the RBI never really wanted actively to attract offshore flows into the debt market. They were very protective about it. And second, we've always prided ourselves as a very large and liquid market, but somehow not part of the global bond indices. So with this inclusion, we have sort of rightfully arrived and taken our place in the global emerging market bonds market. And this inclusion has given us the maximum weight of 10%, which can be in that index. The weight starts increasing from the June of 2024, 1% each month. And we estimate around $20 to $25 billion worth of flows to come into the country. What it does is it takes the ownership percentage of foreign investors in the debt market from a minuscule 2% to close to 4%. Right. So it's still small versus where it can be, where we've seen the likes of Indonesia, Malaysia have ownership of foreign investors. So it's a long way to go, but it's a very welcome start. We think there will be other emerging market bond indices which will look at India and include them over next 2 to 3 years. And overall, the holdings of foreign investors should trend towards the 10% kind of mark. What it does do in the short term for us is for next year's, this inflow will account for roughly 15% of the overall financing requirement of the government of India.
All right.
And with if this combines with the normalization of rate cycle that is expected, it can have a sizable impact of around 25 to 30 basis points on the bond market. It will add liquidity to the domestic markets. RBI can mop up. We expect them to mop up the dollar reserves and add rupee liquidity. And overall, the increase in liquidity and the calming down of rates will help banks to further propel the domestic credit growth requirement, which is there. So we see a lot of positive offshoots from this index inclusion which has happened, and really look forward to next year.
Time now to slip into a short break, but when we come back, we crystal gaze 2024 and look at potential challenges as well, opportunities again for the Indian financial market. So stay tuned.
Standard Chartered and CNBC-TV18 present India on the Move, Season 6. Standard Chartered and CNBC-TV18 present India on the Move, Season 6.
Welcome back to Season 6 of Standard Chartered and CNBC-TV18 present India on the Move, a conversation series where today I am discussing the Indian financial markets with Parul Mithul Sinha from Standard Chartered Bank, Lakshmi Iyer from Kotak Alternate Asset Managers Limited, and Utsav Baijal from Apollo Global Management. All right, Lakshmi, has been a great year for the Indian private credit investments. Suddenly, so much money amidst the funding winter. How do you see that? What contributed to it? And how do you see in 2024 this sentiment getting carried forward?
So, Mugdha, it's a cycle. So, what goes up has to come down, and it's very similar as far as the economy is concerned. If the country's banking sector NPA is at an all-time low, and there is clear, I would say, banks' preference, which is reflected in the incremental loan growth, preference towards the retail loan growth over the wholesale loan growth. Clearly, that creates a very potential ground for private credit funds via AIFs to flourish. And incrementally, we are getting positive about the space. It creates for durable areas of financing across sectors, because most of these funds are sector agnostic. These are EBITDA generating companies in the mid markets which may not have access to mainline funding. So I think all in all, 2023 was probably a small trailer or a peek sneak into what lies ahead as far as the final movie is concerned. And 2024 calendar year could well be the continuum of that journey which we set off in 2023. So yeah, it looks pretty positive. The caveat here is be very clear in terms of your underwriting standards. I think that's what will demarcate the wheat from the chaff. Baki sab badhiya hai.
SEBI has now spoken about alternate investment funds. What is the likely impact on distressed assets, properties, funds, etc. in the near future?
So they are the slightly the greedier cousin of private credit space, as we call it, where the ask is obviously because you are identifying stressed opportunities, the skin in the game is higher, the risk is higher. So obviously the appetite is much, much more. Insofar, incremental opportunities are fewer, because most of the NPA recognition, repair and resolution is behind us. We need to probably wait for the fresh round of cycle to be created to have a proliferation of some of sorts. But clearly, among the existing ones, we are seeing a good turnaround, a good output in line with what was anticipated when these funds actually made their investments. So yeah, I think the going has been good. If you look at the past track record of some of these strategies, right. Investors can't complain.
Utsav, opportunities and challenges. Where do you see the infrastructure investment space? Where do you see investment, offshore investment? And also, you briefly spoke about ESG and green financing. Where do you see that fit in the narrative now?
I think both infrastructure and ESG are two very interesting areas for foreign investors. The projected spend on infrastructure is meant to be double for the next 7 years as it was in the last 7. ESG within that is like almost meant to go up 5 times. So from a need of capital, there are huge opportunities. I think the challenge really in India is that while India has opened up avenues to invest in equity, it's very difficult to invest in hybrid securities. It's not very clear how to invest in debt sometimes. And a lot of these projects require different types of capital, right? If you have a different risk appetite for a completed project versus a brownfield project versus a greenfield project. And unfortunately, it's easier to invest in equity in India, but there's still some gates when you try to invest in debt. There are end-use restrictions, there are pricing caps, there are different rules the government has come up with. Because the RBI historically has always remained a little bit hesitant in terms of opening up the debt flow. Right. Because they're very obsessed about controlling the rupee. And maybe rightfully so. But I think the challenge for all investors is, can you invest not only in the equity part of the infrastructure story, but also in other parts of the capital structure. So I think that really is the challenge and the opportunity for India.
Parul, I'll have the last word. How do you see the global rates now, say in a year or two? And what are your top 3 recommendations really, or so to say, forecast really for Indian financial markets and to stay robust and to stay afloat and to stay solid, as Lakshmi mentioned?
2024 and 25 will be the years of interest rates normalization across the globe. So 2022 and 23 have seen rapid hikes globally, trying to contain the inflation surge that was seen post-COVID episode. And now we are seeing stabilization of inflation profiles, steady decline across most economies. So the next year, 2 years should see the economy starting to reap benefits of how prudently the central bankers have managed the macro conditions. Now, when that happens, it creates opportunities for investors as money will start to look to move from developed markets towards emerging markets. Last couple of years, emerging markets have not seen a lot of inflows. India has been a kind of an outlier where equities continue to attract inflows, but we also expect to further benefit from this movement. The top 3 opportunities that we see is, one is the index inclusion that we already spoke about.
Right.
The other is on the green financing side, where India, as we all know, has committed to zero net emissions by 2070. And that means almost 5-fold increase in the annual green financing requirements from something like $50 billion to $200 billion annually. So we do need to tap global capital to cater to this need. Another growth opportunity we are seeing is tapping the sovereign wealth funds' appetite to invest in long duration assets, be it on the infrastructure side or private capital side. And that's the other pool of capital we should tap. We've seen commitments or interest from the UAE funds, the Middle East funds, to invest in India and drive the growth in the infrastructure investment agenda. So those are a few opportunities that will keep us active and kicking.
Fantastic. A great note to wrap our episode on. Thank you so much for your time and for all those insights. Thank you so much.
Thank you, Magda.
Well, as we delve into the insights shared by our thought leaders today, it becomes evident that India is not merely weathering the storm, but is poised to thrive amid the challenges of an ever-changing global landscape. In the dynamic and unpredictable global environment, India does leave us optimistic about its ability to navigate and thrive in the times ahead. Thank you so much for watching.
Standard Chartered and CNBC-TV18 present India on the Move, Season 6.